Good morning, ladies and gentlemen. This is Brad Matheny. Today is September 17th. We're looking at the QQQ daily chart, and I want to highlight something very, very important here. We may be very close to a critical bottom in the markets, and the only way I can explain this to you is by trying to share with you what I'm seeing through my custom indexes and through the charts, and showing you that we may be very close to a reversal in the markets, setting up a moderate Christmas rally. And I do believe that the likelihood of a deeper bottom right now is probably less than 20 or 30% overall. I think we're very close to setting up a very solid move to the upside with U.S. consumer engagement driving Q4 2022 and Q1 2023 activity a bit stronger, moving away from where the Fed is trying to combat inflation. I believe the Fed's going to do what they're going to do, but I think consumers are already prepared for the holidays coming up, and I think we could see a very solid move higher. So let's take a look at this and try to give you an idea of where we're at. So this 25% support level has really played out. Ideally, this level here, this 321 on the QQQ chart, becomes critical in our ability to see some upward movement. So we have a lower low, very deep support around this extended low formation here. We have a higher low here, and we have a higher low here. Very clear to see, right? We also have an extended downward cycle across these highs. You could almost argue right across here, which gives us the ability to have potentially a moderate neckline. I'm going to try to get this a little lighter. Right across this level. So what I'm suggesting is that we are seeing this higher low formation we last week's trending. We saw a bit of a recovery here. We are looking at this recovery over here. So if we span this out, you can see we have this bit of a moderate left shoulder right here. We have this bit of a moderate left shoulder right here. And we have this bit of a right shoulder here. I'm going to change the colors of these so you can see them a bit clearly. Make them kind of a lightish pinkish color. And I want you to see the clarity of the bodies in this area. So if I were to take and try to draw a line across the bodies here, I would end up coming right across here and coming right across here. Try to get it close to zero. There we go. And I want to show you where we're at with this, because it becomes very important to understand the real potential here. So as we look at this, you can see these lows, these body lows right over here, come right down into this area. In fact, if I were to move it up a little closer, we come right into this area, this let me get you a number, 287, 288.10 roughly. So understand that that is really where we're at with this. This becomes a very critical level for the markets, and I believe we may see this appear to be very strong, very, very strong support in this area. One thing I can do that will provide further clarity is potentially check a Fibonacci from this area. And we do not have anything down in that area except potentially a lower than 0.25 ratio. So we could pick something if we really wanted to down in the you know, 0.156 or something of this nature. But the reality is I believe we're looking at very, very strong support. Now, the next week we have the Fed. We could see a bit of a blowout down in this area. So I want you to understand that trading down in this area is likely, could happen if the Fed really blows some holes in the bottom of the market. But the reality is I think we're setting up a very solid bottom with consumer engagement stepping in. And I am more so expecting to see something along the lines of a bit of a blip and then some sort of a rally phase back up into this area. And that's really my ultimate decision right now, is that the markets are stepping in, forming a bottom. You can see this volume down here. So we had excessive selling volume, bit of accumulation through here, very moderate, weakened out through this topping formation, and then started accumulating as we move down here. So you're seeing accumulation back over here. You're seeing volume pick up. You're seeing some, yes, some obviously big red bars here saying that we're seeing some dumping of shares, but you're also seeing a higher low. You're seeing the left shoulder, the right shoulder, multiple inverted head and shoulders formations. I believe we could very well set up a very solid bottom. And what we need to see in order to have this get some confirmation is a move back above this high. So really, this unique little standout high right here, 310, is really the area we need to see the markets rally up above to be able to see some real confirmation here. That's going to move us back into a Fibonacci upward price trend, a bullish price trend, and that could give us some real upward activity. Now, in my opinion, right now you've got very low risk. So hypothetically, from where we're at to the lows on the QQQ, you've got 4.5 to 5.5% to get below this lower level right over here. Upside potential, you've got 12 to potentially 22% upside if my analysis is correct, if this bottom sets up, and if the Fed move is already baked into the market. So understand that if we come back over here and take a look at this QQQ chart, let me get this set up for you closely as I can. All right, let me try to do it this way then. As closely as I can. Oops. All right, good enough. Leave it right there. This is the Elliott wave count from a peak over here pre-COVID. We have one. So this is a one peak here, 2, 3, 4, 5 up to here. You can see the little AB from this low, 1, 2, 3, 4, 5 up to here. We have the ABC correction, which I've been telling you about for many weeks, which is really more of like an A, B, C, D, E, wave 1, followed by an A, B, C, wave up, followed by an A, B, C, wave down. Now we're looking at kind of an A, B, C, wave 1, and now possibly an A, B, C, wave 2. Could come all the way down into this area here. Could come all the way near this lower purple line, and then turn around and rally upward. And this could be a very strong move. Now remember, from a longer term standpoint, we take a look here. Oh, well, this is counting quite a bit different than what I do. This is an automated system, but still shows the potential the way I'm saying. So we have a potential A, B, C. I'm really counting this move up here as the fifth wave up, starting a wave down, which then starts a movement to the upside. So the way we would have it is 1, 2, 3, 4, and then a bigger wave up here for 5. So this is counting a bit differently than I would do because of the data. But I count this as the end of a wave right here, end of wave 5 wave, correction, ABC, corrective wave, and this now starts a move to the upside, A, B, C, D, E would be something along the lines of this, potentially even much higher. And then this becomes our ultimate peak over here, probably somewhere around 2026, 2027. Oops. So if I were to do this again, so this would move out to 2026, 2027, potentially be a Fibonacci extension of this particular move. So we would come from here to potential here. And we would likely be in the 1.382 to 1.5. This area here, 100% measured move. I actually drew it almost perfectly, folks. The 100% measured move area, right in this area, would be our initial resistance area. And then we would look at these areas here, 1.32 and 1.5, as secondary resistance up in this area. And that means that the QQQ could rally up to 661 or 535 off of this bottom over the next 3 years. So this would be a very solid rally. Give you an example of a strength here from where we're at now. You're talking an 88 to 136% rally if my analysis is correct. And this would confirm if we found the bottom here. If this confirmed into a bottom, just like I talked about, then we would be looking at a broad upward movement to the wave 5, the end of wave 5 for the ultimate peak. Then at that point, we would set up a top somewhere possibly over here, and then start a bigger move down, which would essentially collapse the market down into these lower levels. And when I say collapse the market, this is really going to be a broad correction, because as we've had this big move up, this explosive move up, it's going to be very likely that it takes out wave 5 and possibly down into wave 4, meaning that we would possibly be looking at lows down in this area on the QQQ in the 130 area after being up here potentially in 600, 660. That is a 78% decrease potentially. So that means that we're looking at a broad shift in the market. If we get above this high, let me go ahead and fix this and fix this and come here. If we get above this high right here, as we move forward, that's going to be 332.50 roughly. We get above that previous high on a rotational move, we move back into bullish trending. If we come on to the weekly chart, and there's the high that I mentioned to you that we have to get above. These are weekly charts. You can see we got above this high here. This is Fibonacci price theory at work, folks. And then we got above this nominal little high right back here. So we had two solid confirmations in this uptrend of a potential upward move. We have not come down and taken out any lows. The most recent new lows that we'd have to take out would be this area over here. Okay, we have a little low right here, but that's very, very near term, which we're coming down. We want to come back to a broad standout low, which is this low back over here, and then a secondary low, which is this low over here, which coincides with these areas over here. We would need to see it take out this area to move back into bearish trending. Currently, we are in bullish trending. So hypothetically, ladies and gentlemen, this is bullish and possibly going to move higher. And so that is where we're at with the current trending. And what we have to realize here is that this double bottoming formation or potential head and shoulders, you can see the inverted left shoulder, inverted head, inverted right shoulder, we may be setting up a very big upside move. We might get some rotation in here. So take a look at this from the QQQ. We might see -4, -5, -6%, potentially down to this low, but the upside potential is 20 to 30% if we can get above this high. So So this is 16.6%. This is 30% from where we're at now. If we come down to here, this would be 33 point, almost 34% from down here near this 275 area on the QQQ. So understand that we're setting up a very big move potentially to the upside, something that traders are not prepared for right now. Everybody's thinking this is going to just keep melting lower, which it could. Okay, if it gets below this level here, then we could see this continue to melt lower. Right now, I'm seeing strength. I'm seeing unusual amounts of strength, and it may be that the U.S. markets weather this quite a bit stronger than most people expect. So now let's come take a look at the real estate market real quick and show you what's going on. So we're not seeing a whole lot of activity in the new listings. So new listings right now are very very flat. So we have active listing count is the orange line. You can see this orange line is flattened out over here. Days on market is the silver line. It's actually climbing again. Price reduction share of market year over year is the light blue line, is actually climbing as well. Price reduced count is climbing again. That's the yellow line. And the median listing price is actually drifting downward. So we're seeing weaker pricing, weaker activity in the market, increased reductions, and longer stay on the market before something is selling. We're also seeing the dynamic trend modeling system move back downward again. So you can see the real price factor moved down 1% last week, and the modeled market demand actually increased by about 0.7% last week. The model market demand at minus 46 is the orange line, and the real price factor is the blue line here. Okay, so we're not seeing any real strength in the market. It's going to continue to flag out, and at some point it's going to potentially really start to break downward because we haven't seen any real break in the market yet. With regards to the metrics for the real estate market, pricing trends have moved into decidedly negative territory. You can see here we started to go negative back in January 2022. We have stayed negative on pricing trends generally throughout the U.S. So we're starting to see about a minus 3 to minus 4% general year-over-year pricing trend structure. A real estate price reduction activity. Price reductions are still making up a fairly large share of the market, almost 75, 78%. Yet price reduction activity has continued to weaken a little bit. We're seeing active listings have collapsed. They've collapsed now almost 15%. This is going from November to right now. You can see it's very tight market. People are pulling real estate off the market as prices are coming down. They're waiting to see what happens, hoping the Fed changes direction, which would send things higher again if interest rates were to move lower. And the new listing count metrics are very interesting. So new listing count metrics shows we've got about a 26.7% new listing count metrics. Now understand that this is a continued move here. That's the blue, the new listing count here. So essentially we've continued and we have the same rough amount of homes on the market as we've had over the past, say, 5-6 months. We're not seeing a broad change in how the markets are changing. We've gone from negative listing counts here to positive new listing counts here. People are still trying to offload their homes at the highest price they can. New listing count change is minus 9%. So we're seeing this new listing counts are actually decreasing a bit. We're not seeing them move up like we were back over here at the end of the year and as the Fed was telegraphing the rate increase. And the new listing count share of market is minus 0.83. So what's happening is we're getting smaller numbers of new listings. We're down by about 0.75% overall for the new listing count share of market. And the share of market is the gray line there. Understand that the new listing count share of market is still positive. The new count change, which is the orange line, is now negative. You can see that we had those types of negative activity back over here with COVID. We had it back over here in January 2021. We had a big rotation back over here, and we haven't quite broken down to new lows here, but we're getting very close to breaking down below this 20% level, so we'll see how it plays out. Basically, real estate, I would put it as real estate is in a state of shock right now. If you can get somebody to buy your house, good for you. If you can't, then that's likely because people are going to be waiting out the Fed to see what happens and see, especially at this next weekly Fed rate increase, could put mortgage rates up in the 7.5, 7.25 rate, which is, you know, I don't want to say it, but it reminds me of the 2008-9 interest rates when I was looking at adjustable rate loans in the 7, 8, 9% range. And that's pretty scary because we haven't had 7, 8, 9% mortgage rates in quite some time. Okay, so now what we're looking at here, ladies and gentlemen, as I showed you, the QQQ setup, we need to kind of pay attention. If I were to come back to quarterly, let's take a look at quarterly. Hopefully I don't have a bunch of stuff on this chart that clutters it all up. But, yeah, it's a little too much. Let's go back here to 2 weeks. Okay, so here we go. So what we're looking at here, ladies and gentlemen, is really the potential for an extended move to the upside. And I really do believe that what we're seeing is strength building for the upside, maybe to come back up into this area. Into early 2023, maybe not back up here, we'll have to see. But right now, as I mentioned to you earlier, we need to get above this level, this 304, roughly 30, let's call it 304. And at that point, then we need to target this high, which is 335. And then at that point, if we can get above the 335, we have a chance of getting back up here, which is 367, 368. And that's what I really think is going to be happening over the next couple of weeks. A moderate sleeper Christmas rally that no one's really expecting yet. We do still have the potential for this downward move here. And this would set up the end of an initial wave here and a future move back up with this way. But understand that longer term, this still plays into the broader picture. We have to get above this level way up here to eliminate what could be the excess phase peak, rolling over, stalling, and then breaking. And that's what we could see on the excess phase peak pattern. In order to break above that, we have to get above this level here, draw it right across here, and then eventually get above this level over here and continue our move higher. That would mean we're going to complete a wave 5 to new highs. If we stall out back over here and come back down, which we'll be watching for, then the excess phase peak is setting up, and this downward move would mean that we are going to retest support back in this area before breaking out and potentially moving downward. All right, that's your update for now, guys. Get ready. I think we could be looking at a bottom in the market, and we will know within about 30, 35 days whether I'm right or wrong. Because if I'm right, we're going to see a decided change in direction after the Fed next week. And if I'm wrong, we'll see new lows and extended trending to the downside. So be prepared either way. Right now, it's good to be on the sidelines. It's good to be safely in cash and properly hedged. Metals should start to move. Follow me on Twitter. Follow me on YouTube. Watch for my updates. We're getting ready for a pretty big move. All right, guys, that's it for now. Good morning, ladies and gentlemen. Today is the 17th of September. This is Brad Matheny. We're going to go over the weekly update, starting with these custom index charts, and we are going to go over exactly what's going on in the market, and I want you to be prepared for something potentially very big over the next 3 or 4 weeks. So what we have right now is the volume ratio chart, and you can see we had a little bit of buying volume last week, and we moved back down here to this low level. We're in kind of an accumulation phase with regards to buying activity. quite a bit of upward activity over the past couple of weeks, but the last week we saw the markets move downward on the strong CPI and PPI numbers, but I'm still seeing some accumulation. So we're in kind of an early bottoming stage, I believe, in the markets, and we need to see how this plays out as we go forward. With the U.S. Custom Valuations Index, you can see last week we moved broadly downward again. This is a monthly chart. So this is currently September. We are not near the lows. We've had the lows back down here near 2.9, roughly 2.85. And we are not seeing extreme selling pressure take place right now. We could see a bit of it early next week, but I think the Fed rate increase has already kind of been baked into the market. I'm looking right now for the potential end of this move. You can see a very clear A, B, C pattern, and I believe we might be starting an A, B, C, D, E type of pattern before we move into a real solid Christmas and possibly Q1 2023 rally phase. So we need to see how the markets hold up. We're not seeing broad selling. Even though the markets went down last week, we're not seeing a lot of broad selling. We are still in a bit of a downward trend. We're looking for some support to hold, and we're looking for potentially a Christmas rally to take place. But we're not really seeing a whole lot of direction right now. I guess the way I would say it is we're seeing accumulation. The U.S. stock markets are holding up better than global markets. The Fed is likely to continue to raise rates. But long and short of it, ladies and gentlemen, consumers are engaging. They're still spending. Inflation is weakening slightly, and I believe the U.S. market is on a totally different level right now, very possibly looking to form a bottom and moving into a moderate Christmas rally, potentially carrying over into early Q1 of 2023. The large cap index is stalling out. You can see here, formed a bottom, kind of moving sideways, looking for some support. Really, again, same setup, A, B, C type bottom. This could be a D, E rotation. We might get a bit of a new low next week or the following week, but I'm starting to lean towards the fact that I think we're near a really solid bottom area here. We haven't seen it form yet, but I believe we're starting to get the real early inclinations of a potential bottom. U.S. to global market index, you can see the U.S. market is bottomed out over here. This is weekly, and you can see it's holding up fairly well right over here. The reality is the global markets are weakening, still showing signs of bearish trending rather strongly, new lows all the way down. We're getting back down here to these COVID lows on the global markets. We only have, it's still since 2017 or end of 2016 roughly, still positive for the year, whereas the U.S. markets are plus 54%, global markets are almost flat at plus 5.9%. I believe the global markets are going to really come down here and try to find a bottom. The U.S. may come down into this area, down in, drop maybe another 3 or 4%, 5%, and then form another bottom here, highlighting, staying off of these lows, and maybe beginning another wave higher as the Christmas rally sets up. We need to see how this works. The global asset index is still consolidating in a sideways channel, very, very low. This is a monthly chart. You can see we're down here near this low range. We got to stay above this low range and not break down if we're going to see any chance of upward movement. Same thing with everything I'm going to show you right now. We are seeing support. We are seeing that the U.S. market is quite a bit stronger, but we're not seeing any real solid downward trending. Okay. And then here's the current gold cycle index. The gold cycle index is holding up quite well. You can see we had a bit of a white bar here, an empty candle. That's showing us that we're seeing a little bit of support. You can see we've had this rally and blip here. The RSI indicators turn positive. The stochastics has turned positive. This is telling us that gold and silver may be starting another rally phase here. I know that it's been selling off and moving downward, but this is very, very clear. We're in the late stages of this move. You can see how these late stages have prompted fairly big rally phases. change in direction. I think we're going to see a pretty big change over the next 3 or 4 months with gold and silver, and I'm fairly confident that we are looking at a major bottom in gold right now. This is a very solid washout low. We've got to see how it plays out over the next 2 or 3 weeks. See it get back above 1765 or a bit higher. That would be a very solid confirmation, and we shall just go from there. Next, we have the Consumer Engagement Index, and this is something I want to bring to your attention. Consumer Engagement Index is rallying. Consumers are spending money. They are still out spending and buying in the U.S. market. We are not seeing the same type of deflationary type of trending that we saw here from 2021 to the lows here in June of 2022. We're now seeing a resurgence of consumer activity, and I believe this is more in the retail side of things and with specific purchases in the consumer sector. But I need you to understand that in 2014-15 we had a contraction, and then it started to take off. Back over here in 17-18, early 2017 we had a contraction, then the market started to take off. And of course here we had the COVID contraction, and then it started to take off. If we get back above this, let's call it 17 level, 1650, 17 level, then we could be looking at a fairly strong Christmas rally, potentially driving up into this area here, maybe even a little higher, depending on what happens with the Christmas holiday season and early Q1 2023. So pay attention. Right now, even though we're seeing some broad weakness in trending, we're seeing a real big shift here, and this could prompt a fairly solid upside move, and we just need to wait and see how it sets up. Next, we have the technology ratio, which I highlighted in a special update for you all this weekend. Technology ratio is flattened out. We're back down here near these 2015 and even 14 lows. So we're way back down into this level, and if we were to break below this level, we would be looking back over here, which is the 2011, 12, 13 lows. What we need to realize is this is an extremely low level for the technology ratio index. This is a very solid bottom setting up right now. As long as we hold above this purple line, it may provide you an excellent opportunity to start dipping your toes in the water with certain technology stocks with a very low risk setup. So right now, like I said, even though there's risks on the table, we could see a continued unwinding. I'm starting to see some signs that a Christmas rally is really going to come, and I'm starting to see some signs that we may see a bit of an upward move. Where would it go from here? Very likely it could go from this level up into this 45-50 level fairly easily, which would represent about a 20 to 22% increase in the technology sector from where we're at. That may include the ARK Innovation Funds and others. So be aware that we may have some sort of resurgent rally over the next 6 to 8 months in this sector, in technology, and in the broad cap in the U.S. markets, just because we're starting to really wane out. We're losing our momentum on this downtrend. All right, that's the end of that. Now, let me come over here and highlight the gauges. So the gauges this week is that we have no changes in the rotational modeling system. Everything is still the same, but I am in the process of changing out these gauges. So you're used to seeing these as long-term bullish, short-term bearish, just like it's saying here. Long-term is the longer line, short-term is the shorter line. And then we have our allocations with trending. Stocks are showing trending as moderately bearish with 15%. Cash is strongly bullish at 40%. Metals are moderately bullish, meaning I believe we're still in an uptrend and forming a major bottom at 25% allocation. And bonds are moderately bearish at 20% as a hedge position. Then we have the alternate allocation table, simply for people who are not able to invest in metals. And what I'm going to do, ladies and gentlemen, is convert these same charts that you see, or these gauges that you see every week. Sorry, that's the wrong direction. This one. Excuse me, a little phlegm. We have the NASDAQ, ES, YM, Industrial, Transportation, SPY, Gold, Silver, and Oil. These are the same gauges, long-term, short-term, long-term, short-term, long-term, short-term. I'm converting these to this structure right now. And what we're going to have is this is going to give you the same information. Long-term, short-term, long-term is weekly, short-term is daily. Let me zoom this in a little bit. You have the same long-term, short-term structure here, bullish, bearish, 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 bullish, bearish. This is long-term, this is short-term, daily, weekly. You have the primary allocation levels here, which is what we just went over, stocks, cash, metals, bonds. And then you have the alternate allocation table here, stocks, cash, bonds. Additionally, you're going to have the ability to, wrong direction, see the current position for the momentum, the rotational modeling system, the MENT rotational modeling system. It's basically broken into two allocations, weekly and daily. Weekly is a 25% allocation, daily is a 75% allocation. This is what produced these results. You have the current position right here showing where we last took a trade on this level, where we're at right now, whether we're plus or minus a certain amount, what our current position is last year. Weekly, SPY 610.2020 is bullish at 319.34. We're at 385.56. We got 20%, almost 21% profit in the trade. Everything's going to get converted over the next couple of weeks as I restructure things on MENT.com to provide you more information. Now, you also have the alternate signals here. This is for you to determine on your own whether you want to trade the SSO or SDS. You can see that while we're bullish the SPY, the SSO, which is the bullish 2X ProShares ETF, is also bullish. The SDS is bearish. So if you're unable to manage your account efficiently, what you would be able to do is, if you can't, this requires two accounts the way this is set up right now. But ideally, what you could do is move a bulk of your position here into the daily, and you could alternately run with SSO or SDS as an alternate position to take advantage of the 2X signals that come up. That's the purpose of this, is to show you where we're at, what we're doing, and this is going to get expanded upon as I continue to change things on the website. The idea here is to provide more information, more resources, provide you better clarity as to what's going on, and clean things up so you can see what's happening. Okay, next we are going to move to the TT scanner. This is the current TT scanner image. Nothing has really changed. We're starting to see a bit more accumulation. We are still short Nugget, GDXJ, and GDX. We are still long XOP and XLE. These have been in place for many, many weeks. It's kind of a bifurcated market right now. Energy is still moving higher. Metals are moving lower, and miners. Everything else is in a neutral, non-trading position, which means that we should be very, very cautious with our stock trades no matter what we're doing, which again is why I have the allocation levels, wherever they are, right here, so low. Stock allocation level and primary is 15%. Stock allocations alternate is 20%. We have most of our money stashed away in cash. What we're trying to do right now, ladies and gentlemen, is protect against unwanted risks. So even if you were to take a consideration trying to trade 5 or 10 stocks, you would take that 15%, divide by 10. It would end up being 1.5% of your capital in every stock. So hypothetically, if you took a 10% loss on that stock, on any stock, that would end up being a 0.1% loss on your portfolio, 0.1% loss on your portfolio. So the idea is we have that very, very tiny with regards to how much we're allocating to stocks and how much we're reserving. Okay, next we are going to go to the core inverse. So this is the core inverse hot list. These are ETFs. These are inverse ETFs. They would technically be moving higher in a downtrend. You can see we have one trigger here in EUM, which is the MSCI Emerging Markets, long for 21 weeks, hit its first target, has 13.93% profit in the trade. ERY, Energy Bear, is short, which means it's shorting an inverse bear, betting it's going to go up. From 1 week ago, we have minus 5.06% in the trade, haven't hit any targets. And we have DRIP, which is oil gas exploration, from 2 weeks ago, minus 12%. We haven't hit any targets. This is likely going to get stopped out if the trend continues. So these are two losing trades. This is one winning trade. Now, if we go to the, let me come in here. Must be this way. This is the current core, TT Scanner core ETF. You can see we've got a number of trades here. We have one new trade here in telecommunications, IYZ, which is a short. This was from last Monday, it looks like. 5.8% profit in the trade already. We haven't hit our targets yet. We have Energy Trust is long. DBA, agriculture, is long, 37 weeks. Hit both targets. Nice profits in here. Let's take a look at anything newer. Right here, UGL, ProShares Ultra Gold short, 2 weeks old, 7.65%, have not hit any targets. And we have the new trigger here, and we have ARC Internet is short, it's 18.69% in profits, have not hit any targets yet. So understand that the way this is working, this is giving us the opportunity to position trade in core, and this is really position swing trading. These are weekly, so you're going to be holding 19 weeks is what, about 4.5, almost 5 months. So the idea here is you're holding a position for an extended period of time, managing it, looking for swing trades. Now, obviously, with the small allocation we have in stocks, that means that we're going to be, you know, again, a 27% profit in this particular trade. If you're trading 10 stocks at 15%, that's going to end up being a 2.7% profit target. Excuse me, a 0.27% profit target, the way it's going to work out. Maybe a little higher, 0.3, no, it'd be lower, 0.18. So it's very low risk for you to do this, but you can still accumulate gains doing it this way. The rest of the money that we have in cash is riding on the strength of the US dollar right now. Okay. So nothing's really changed. We have one new trigger here in telecommunications. What we're looking for here, to be honest with you, is a change in the movement with regards to technology. Looking, for example, for XLK to really begin to take off, or, for example, ARKQ, or, for example, come down here, where would it be? Where would it be? Real estate, no. Miners, no. iShares, no. Ultra Gold, no. So we're really looking for a change of trend here to take place, if my assumption is correct. Let me come back over here to the next one, which is the value scan. Now, value's got one new trigger in MMM, which is a short. Let me zoom in here. 5, or it looks like 6.2 profit. Haven't hit any targets yet. So we have a new trigger here in 3M company. Otherwise, we have a bunch of existing triggers. We have Dow right here. We have a short trigger that's 1 week old. We have 6.97% profit. Sorry, I have to shrink this down because it's got a lot of data in it. And we have this one here that's 2 weeks old in WBA, which has looks like 9.7 or 6.7% profit. Has not hit any targets yet. And then we have this one here in Verizon, which is 5 weeks old, 8.32% profit in the trade, has already hit the first target. Otherwise, we have longer term trades in place. The value hot list has still showing quite a bit of bearish trading. You can see here, bearish trending. Very few bullish trending right now. So we're not seeing a lot of upward trending on any of the hot lists. Our selections are very, very limited. What we're looking for in this regard is to catch some potential winners. You still have an opportunity here on the 3M trade, on the Dow trade, and on the WBA trade. All the others are running kind of extended, meaning they've already hit their targets. You've got a protective stop. What will you be looking for is some downward, like this trending here on the thrusting pattern here is neutral but bearish, minus 50. This is minus 23, minus 27. So this is trending downward, minus 23 red. Minus 27 purple is trading a bit sideways. This one here, minus 50, is a pretty strong bearish number, meaning minus 50 is a big number for thrusting, but we would want to see this move into a red trending scenario. Okay, so now let's end this right here before I move on to the next section, which will be going over the real estate and the active charts themselves.